REITs have an opportunity, given the vast amount of real estate in different types, to be a leader in growing the EV charging grid.
Joining me today is Paige Anderson, partner with Vinson Elkins. Paige, thanks so much for joining us today.
Thank you for having me.
Now, you wrote an article about REITs and EV charging stations recently. Can you tell me a little bit about some of your key takeaways?
Yes, the challenge for REITs now in terms of EV charging stations and the tax law is that they don't fit neatly into existing guidance on tenant services. Back when I wrote the article, there was some question about whether they were customary as a factual matter. I think we've moved along in the past 2 years quite a bit in that regard. Where the rub is that if REITs want to participate in the profits at all from EV charging stations, it is not clear whether they align more with parking services or as a utility. Parking is one of the few places where we actually have authoritative guidance from the IRS, and it's fairly restrictive. An independent contractor essentially has to handle most everything but the most routine functions, and the REIT can't profit from it, which seems fairly restrictive, even if they're customary. On the other hand, the IRS has been fairly liberal with utilities being able to be included in rent, and even REITs making a markup on that. So that's pulling in two different directions on whether a REIT can participate. And so, I think without the IRS stepping in, I've generally been advising clients to be more conservative at this point, but I don't think that's great for REITs or for charging vehicles.
And what are some of the requirements, opportunities, or issues for REITs with respect to these EV charging stations?
Well, the main thing is attracting tenants. Whether it is you have a multifamily complex and, a renter has an electric vehicle, they're going to want a charging station there. Shopping centers, the idea is that you can attract more customers with it. So, maybe the question of whether a REIT really can profit from it is less critical than, whether they can have it as like an amenity or service, depending on which way you analyze it. But that's a real thing. REITs have an opportunity, given the vast amount of real estate in different types, to be a leader in growing the EV charging grid. But until we get further guidance, they're probably going to tend to take a more conservative route on it, which means not fully realizing the potential there.
And finally, what are some of the outstanding issues for REITs in connection with the Inflation Reduction Act's transferable tax credits as they relate to solar energy?
Yeah, so that was the IRS proposed regulations on this point were interesting because they responded to various questions from the REIT industry, but they didn't actually include any of it in the proposed regulations themselves. It's entirely in the preamble. The two things that I think I would highlight the most is the impact on the prohibited transactions tax. The IRS said in the preamble, essentially, that because there is no gross income when you sell a credit, then there can be no prohibited transactions tax. This correct answer. However, the safe harbors for the prohibited transaction tax for any sale, say if the REIT went and sold a piece of real property after selling energy credits, take into account other sales made by the REIT and the total number or volume based on fair market value or basis that the REIT sold in the year. So if the energy transfer counts as a sale for that, REITs also selling real property could find themselves out of the safe harbor pretty quickly. And that can be challenging and expensive because it puts you into a facts and circumstances analysis with respect to the tax, and then usually being required to be supported by memos or opinions by the lawyers. So a little more clarity there would be nice. The other issue is that the effect on earnings and profits has not been addressed at all. This really, isn't just a REIT issue because it affects any corporation paid dividends, but of course REITs pay regular dividends as compared to a lot of corporations. It would seem that earnings and profits is increased, but it's not particularly addressed. And then there is a difference between if the credit is sold directly by the REIT or by an operating partnership with the REIT. You have no gross income if sold by a REIT directly, but if the REIT receives a share of the proceeds through its operating partnership, it's reported on the K-1 as tax-exempt income. Shouldn't be treated differently for E&P purposes, but because it hasn't been addressed, normally tax-exempt income would increase E&P. And so if there's a difference there, it would be helpful to get some resolution from the IRS.